started looking at the projects that we did that were the most successful, and every single one of them had some sort of funny or unique story to how we found it, how we were able to buy it versus somebody else, what needed to happen to it to build value into the property. And instead of looking for IRRs and spreadsheets, I started looking for the story behind each deal.
Sure.
And that became actually a fundamental way that we do business now. Is what is the story? What can we do to this asset to transform its value and build wealth for our clients?
That's interesting. People remember lyrics, song lyrics, and movies forever, and that's the story. All right, today we're talking about reinventing the way you build wealth. And today in our studio we have our show guest, Chris Loeffler, the co-founder of Caliber. Chris, welcome.
Thank you for having me.
Yeah, absolutely. So reinventing the way we build wealth. What is a wealth development company?
We started our company Caliber about a decade ago. And when we first got into this business, we realized that we filled a very significant gap in the way that people invest. Stocks, bonds, insurance products was sort of the way to go, right? And most people didn't have access to doing private real estate deals. Maybe they had a neighbor who had done one before, and they talked about it, and that's how they learned about the business. And they'd meet somebody in a coffee shop, and they'd find a developer or something like that. But in most cases, the broad majority of eligible investors didn't know what private real estate was. So we said, well, what business are we really in? Are we in the business of doing real estate or building buildings or doing deals, or are we in the business of building people's wealth? And that's where we decided to call ourselves the Wealth Development Company, focus on building different investment vehicles or funds that would allow somebody who wasn't an insider in this business to access the same type of investing that longtime family investors, developers have done for decades.
Right. Hey, let's take a look at a clip from Caliber real quick. And those are some exciting projects. Now, I mean, when you talk about the idea of building real estate wealth, a lot of people go into it with the idea of returns and yields and trying to understand the brand story around creating wealth. But it's mostly been focused on the deal, right? And so when you're focusing on the benefits of going through a platform like this, you've built a company, or you're building a company with time-tested models, just real estate fundamentals. What approach are you doing today to build a platform that can take somebody that maybe saw an HGTV home flipping, channel on, hey, there's some opportunities in real estate, but they really don't. That's just really just getting them excited about it, but don't have the capabilities to understand how to evaluate that stuff. Talk to me about what you're building for.
Well, most people don't have the time to really learn this business at the level you need to be able to be successful as an investor. Or if they do have the time, they might not have the access to the right people, the right projects, the right deals. They might not have the capital to do a $10, $20, $30 million deal. They could do a couple $100,000 single family rental, but at some point in time, if they want to get into those larger projects, they might not have the capital. So you add all those things up, and we said, well, how can we give people the access, the time, the ability to partner with an expert in the space, and the ability to come in with $50,000 or $100,000 to invest instead of 10 million.
Right.
So that's what we started with, was looking at their needs. And coming from that angle, if you look at most investors, they're either in a growth phase when they're investing, or they're in an income phase.
Okay.
Or they're looking for some form of balance. And so we started to create different types of funds, two of which that we have that are focused on just growing your wealth, making the best possible return we can for the efforts that we're putting in. And then two other funds that are focused on producing a regular, predictable monthly or quarterly income. And so we started to just look at creating investment products that would fit the needs of the clients, and then figuring out how does that product fit into the world of real estate investment. Well, the income products are focused on private lending or residential real estate because it's very predictable. It's less risky in terms of the ins and outs of cash flows. The growth products are focused on commercial real estate because that's where you get the big return on investment typically.
Yeah. And so you take an approach, and I want to dive into this deeper with Caliber and what you're doing with the every deal has a story. What is your story? I mean, you've put together a phenomenal platform, time tested.
Yes.
Lots of transactions.
Yep.
I mean, and the financial background that you have is impressive. So that's, I bet, serves really well for investors. But where are you and how did we get here?
Yeah. So I grew up in a military family. Was born on the East Coast, bounced back and forth, East Coast, West Coast, lived overseas in Singapore for a little bit. So I had a chance to see a lot of different things at a pretty young age. Went to school for accounting, became a public accountant, thought I was going to go conquer corporate America for the rest of my life. And then 3 years in, decided to leave my job at the height of the Great Recession and start this company. And so why? Because it was fun. Because I was well supported, because I got connected to the industry in a very unique and different way, and because I saw the opportunity. And the biggest thing was we started the business. We started by buying homes and flipping homes at foreclosure auctions, because that was what you did in late 2008, early 2009. And then towards the end of the first year of our company, I realized I actually had a unique opportunity to move from being the CFO to being the CEO of the company, and I realized, wow, these investors value what we do beyond anything they've ever had access to in their portfolio in their entire life. They understand how we're actually making them money. They see the transactions. They have that level of transparency that, they look at their stock portfolio. They have no idea what's going on within any one of those particular companies. And so when I saw the value that they put on us, the light bulb went off in my mind that, we can do this at a much bigger scale. We can grow this access beyond 20, 30 people to hundreds, eventually thousands of people. And that's where we started to go. And then on the deal side, I started looking at the projects that we did that were the most successful. And every single one of them had some sort of funny or unique story to how we found it, how we were able to buy it versus somebody else, what needed to happen to it to build value into the property. And instead of looking for IRRs and spreadsheets, I started looking for the story behind each deal.
Sure.
And that became actually a fundamental way that we do business now, is what is the story? What can we do to this asset to transform its value and build wealth for our clients?
That's interesting. People remember lyrics, song lyrics, and movies forever, and that's the story. Here we are sharing your story. That's pretty cool. Tell me about that transition from CFO to CEO, because I got to tell you, that has to be just a unique ability and a strength for an organization to have a CEO that has that also financial steering wheel mindset of the organization, because at the end of the day, those are the things that matter most, I think, especially in an investment platform.
They say that some of the best CEOs have accounting backgrounds because they can kind of, they can understand enough to be dangerous.
No hiding the ball, right?
I definitely am a better CEO than I was an accountant or CFO. We have an incredible team now, that we're supported. Actually, one of the largest groups in our business is accounting and finance and financial reporting, because, taking care of the investments, taking care of the funds, and actually helping the investors understand how we're making them money and how we're growing their wealth is very important. But it was a tough. I never had any training in sales or marketing, or didn't know how to relate to people. I knew how to relate to spreadsheets really well.
Right, it adds up.
So I got a chance to learn on the fly, and it all came from mentors. Really, really smart people who took time out of their days to say, "Hey, I like you. you seem to know where you're going, and I want to help you. And I would just, if I had one unique ability, and it's still kind of my one unique ability, is I was able to absorb from them their great talents, and just by being around them and listening to them and seeing how they talk to people and seeing how they acted and that kind of stuff.
Right, and now you're speaking. I mean, I've seen you out in the marketplace helping people understand what's next in some of the regulatory opportunities that you're working on. How has that impacted your business, being able to broaden your reach in terms of thought leadership or just getting to know others through those channels?
It's the core of what we do. I have a heart of a teacher. I like to teach people. I feel like if I teach people information about what we do that's actionable and real and valuable and kind of cuts through the noise of the hype of our business, it empowers them. And can they take that information and go do what we do? Sure, but it's a lot of work.
Right.
And most
it's the execution that's important, right?
They hear about it, they understand how it works. We were recently at a large conference, and opportunity zones was the big topic at that conference. And I was really pleased because somebody rushed us down in the hallway after our panel and said, I've been to 20 opportunity zone conferences, and that was the first panel I've sat and listened to where I actually understood the real value of this program.
Sure.
And so I love to be able to try to deliver that to people.
That's great. And as a CEO, having that strategy is important for setting the marketplace, because you're redefining some really exciting things and setting a new standard around this investment platform. But for your own company, beefing up the business and having that leadership and financial strength, but also teaching the industry. I'm sure some of that complexity that comes in the programs you're operating in also is helpful in reducing complexities inside the organization. Talk to me about what kind of a culture you're creating and when you're helping investors at this level.
We learned pretty early about the power of aligning everybody's interests. Our interests, our clients' interests, our team's interests. And we learned early because we made some mistakes in how we structured our company. And what came from that was we have to make sure that in order for our employees to win and for us to win and for our clients to win, we have to generate a profit, and we have to distribute that profit to the investors. And so we structured the entire economic infrastructure of our company so that in order for our employees to have a great year and for us to go home with bonuses and all the things that we want when we build a business, that has to come from profitability from the assets. And so that's one component of our culture, is that built a concept that we call do what's right for the assets. There's a lot of times when maybe the investment manager's interests are contrary to the investor's interest, or maybe the investor's interests are contrary to the life cycle of that one particular asset. You've got an investor that needs to get out because of some family issue or whatever. And so we try to figure out, how do we align our decision making towards one North Pole that will always serve everybody's interests to the best possible. And that was, take that asset, look at it from an individual property standpoint and maximize its value. And as long as we're doing that, sometimes that means we're holding back distribution. Sometimes that means we're changing the business plan. Whatever that is, that will ultimately be what's right for our clients, which is ultimately what's right for us. And so the whole culture at Caliber is built around this concept of do what's right for the asset. And that's what aligns and keeps us all stuck together.
Understanding who that customer is, right? I mean, and people can run into some complications and obstacles and even single funds for one asset with a certain amount of investors that, like you said, one person wants to, there's paperwork involved, but also capital changes the economics of things.
And as you know, every real estate deal almost never goes exactly according to plan.
Right. Usually better, right?
right. Yeah, always better, right? But no, I mean, you've got to be able to have that kind of a team that can move with the plan and communicate with the investors, because the investors are smart. They understand things change, and as long as you're upfront with them, it tends to go well.
So talk to me about your fund, because some things are changing around opportunities. It used to be that accredited investors and certain high net worth individuals were really benefiting from some of the programs and strategies, both from tax and acquisition and just scale. Are things changing for the investor? Someone that might be making $150,000 running a portfolio, but hasn't had enough capital to go out or time to go outsource and pull all these teams together to pull off a deal.
It's all coming down, from a very high bar down to a lower bar. So, for the last 100+ years, the family office investor has invested in private real estate deals and built significant wealth, and typically as defined by having $100 million or greater net worth.
Right.
Because they could write the single check to buy that one project or that deal. That has then migrated down to the accredited investor, which is having a net worth over $1 million or having an annual income between $200,000 and $300,000, depending if you're married or not. And that has opened up 12.5 million households in the U.S. Who are accredited and could potentially invest like this. And it's companies like Caliber that are actually giving them the access to do it. So we've built our entire business close to, $500 million in assets that we've done, as well as another $500 million under development, with about 600 investors and of those accredited class.
Right.
But then even more interesting to me is that last year, or I think it might have even been this year, they passed a bill through the House that's expected to pass through the Senate because it was a bipartisan bill that will actually even further sort of allow more people to become accredited investors that don't have a net worth of $1 million.
Right.
Maybe they have a good income, like you mentioned, but they're still building their net worth. Or maybe they're an industry expert. They've been taking care of multifamily their entire life. Why can't someone like that invest $50,000 into an apartment complex?
Right.
Why do they have to have this arbitrary standard? And
right.
So the opportunity to become an accredited investor, in my opinion, over the next couple of years will expand greatly. And we'll probably go from 12 million households to 40, 50 million households.
Right. And that's really important, what you're talking about, is because it's good to have those opportunities open up. But at the same time, the playing field, the bar has to be raised to protect. There's always risk, right?
Yeah.
Going into every investment.
Yeah.
And I know you're really focused on really helping explore the fresh approach to new regulatory opportunities, with specifically the opportunity zone stuff, but also creating an industry, raising the bar around how investors are coming through this channel. Because if things don't go well, that's usually when things tighten up and people compliance and all of those types of things happen. And so, what are you doing as an organization to help investors get more clear about how you take care of the real estate? Is it the team you've created?
Yeah.
Or you have the track record, so that's the easy test.
That's the
that's
starting
an important
point. It's the most important.
Because there's a lot. There could be a startup.
Yeah.
The same idea.
Yeah. With
great resumes, great backgrounds, but no seasoned deal flow or even cycles that have gone through.
Real estate is a team sport. You can take 5 of the best stock pickers on the planet and set up a hedge fund.
Yeah.
And it'll probably be pretty successful. But you could take 5 of the best, real estate deal people on the planet, stick them together in a room, and they'll be ready to shoot themselves in a week, because you've got to build that cohesive team. A real estate development happens over years, not over days, and it requires thousands of decisions to be made well, so that the ultimate outcome is a profitable project. Mm-hmm. And so it's just not that easy to form a real estate company. Some of the stuff that we've done is, first we started out with a communication platform. So we do an annual conference. We do monthly events all throughout the U.S. in different areas where we have pockets of investors who want to get to know us or want to get an update on what's going on with the company. I do a monthly CEO call. We do significant email-based, communications, newsletters, marketing, et cetera, so that we keep the communication high. Because as long as it's high, I think it allows investors to feel comfortable that we're still out there working on their behalf on these long-term deals. We've added an investor portal where they can log in and see, exactly what they own and what their holdings are and what properties are in each fund and that kind of stuff. Yeah. So that's continuing to develop and grow. And then most importantly on our side is that we made a decision 3 years ago to take our fund sponsor, which is our operating company that acts as the investor's co-owner, public. So we have a public company infrastructure whereby, we're set up to report to a whole new standard of accounting, finance, transparency, et cetera. And so, when you invest in a caliber fund, you're a limited partner in that fund, and the general partner is the public company. And that company also owns a developer and a contractor and an asset manager and all the different things that you need to make sure that whatever we decide to do on a piece of real estate, if we're using a third party and they're not successful, we can step in and fix the problem.
Yeah.
And so I think that for a very long time, this business has been done, relatively small shops, family-owned companies, which are great, but they just don't have the resources, the time, or the capacity to report to the clients at the level that a public company does, and ultimately mistakes get made, and it's often innocent. It's just, look, we were too busy leasing up the property and fixing the potholes. We don't have time to do all this stuff, and we lost track of it, and we had a bookkeeper that came in and took advantage of us, or something like that.
Right.
And so I think as this industry grows, and exactly as the base of investors come in, that gets bigger and bigger, there's a demand that will continue to grow to say, look, we want you to invest like this, but we need to make sure that we protect the investors.
Right.
And we're going through that as we grow.
That's great. Technology is helping us a lot with some of those investments. I want to dive into more of some of the things you're doing with a fresh approach to the regulatory opportunities, specifically the Opportunity Zone.
Yeah.
You've become a national expert on that, and so tell me, what are you excited about for the Opportunity Zone?
Yeah, to the extent you can.
And a lot of our viewers might not know specifically maybe we should just start with what is.
What is an opportunity zone, right?
That sounds like they've named it right.
They have, and to a certain degree, if you're in the world of real estate or finance and you haven't heard the term opportunity zone, you're probably hiding under a rock at this point in time, because everybody's just getting hammered with this thing, and there's a lot of talk about it, but not a lot of people that are actually invested or doing it yet.
Okay.
That's starting to grow. What this is it came from a law that was passed, a bill that was passed as part of the last Tax Cuts and Jobs Act back in December 2017. The tax bill, basically, as people refer to it. And what the bill did was it created 8,700 different opportunity zones, which is basically a census tract. So think of a neighborhood within a city that are now federally designated. And if you invest in real estate or businesses in these zones, you have the ability, if you do it through a qualified opportunity zone fund, to gain a significant tax benefit. There's 3 benefits. The first is a deferral of your taxes. So you earn a capital gain from selling stocks or selling, a piece of your business or selling real estate. You have to invest the capital gain component of that sale. So if you sold a piece of real estate for $10 million and $5 million was basis and $5 million was capital gain, and you can invest the entire $5 million in gain into a qualified fund. The fund invests into real estate deals in these zones, and that's how you get this benefit. So the first benefit is you defer taxes. So instead of, if we used a $10 million example, instead of paying $3 million in taxes and having $7 million left to invest, I get to invest the full 10. So I do that for a period of time, and I don't have to pay my taxes for about 7 years. That's the deferral period. Well, if you have $3 million, they're making a rate of return for 7 years. Right. You would have given the government. That's a nice benefit.
Right.
The second benefit is if you stay invested for 7 years as of this year, you have to pay it when you finally do pay your tax bill. Instead of paying tax on $10 million, you pay tax on 85% of that, or $8.5 million. So you lower your tax bill. And the third big benefit, which is the sort of the big kahuna of the tax law, is that if you stay invested in the program for 10 years, you pay no capital gains tax when you sell your entire investment.
Wow.
So,
and that's a great, you want to underwrite to 10 years anyway, right? To be
if you
flexible.
can take your 10 million and turn it into 20 or 30, when you sell, you paid your tax on your original 10 at a reduced rate, but now you're paying no tax on the exit. It's like a gigantic Roth IRA.
That's amazing.
The math is compelling.
What is the intent behind this, though? I mean, this is to get investment to regions that aren't, attracting investments?
Yeah, it's to get investment to regions that are just about anywhere other than the Silicon Valley, New York, Chicago, places that naturally attract significant development dollars. If you have a good project in the city of San Francisco on the right piece of property, you're going to get funded.
Right.
If you have a great project at the greatest location on the planet in the city of Tucson, Arizona, you may not get funded. And so what this is designed to do...
The yield's driving a lot of those decisions and the deal, but now...
Yeah, investors just sort of favor these major markets. It's always been that way. And so this is giving an investor a significant tax incentive to take a step back and say, hey, there's great places to invest all over the country.
Right.
If you read about this, they talk about distressed communities, and some of the communities are distressed, and some of the communities are just growing, economic, developing communities. So it's a very unique opportunity for those of us in the real estate business.
Yeah, and where are you focused? I know you've got a lot of concentration in Phoenix, and so talk to me about what you're excited about in those markets.
We call ourselves the Greater Southwest Growth Markets, which is a term that we made up. But it's Arizona, Colorado, Texas, Nevada, and Utah, and we picked those markets because that's where we've been investing for the last 10 years. They have a long-term trend of population growth, long-term trend of job growth. We can be the big fish in the small pond, so to speak. Typically, local politics or state level are all growth-friendly or growth-oriented, so it's nice to be in that kind of a situation. And then we got this wonderful gift from the federal government that said, hey, here's a tax incentive to invest in these locations. Well, the opportunity zones located in those 5 states are some of the best in the country. So it just, it kind of worked out well for us since that's where we were already investing.
Right, and so in order to take advantage of these zones, what are the things that have to come together? I mean, is this something you can do on your own? I mean, it sounds to me like...
You can.
You have to really...
You can if you want. They design in order to sort of create a safety net for lack of abuse of the program, and people not being overly abusive with the way that they use this program to invest. The federal government said, hey, that's why we want it to come through a fund. That's why it needs to be a qualified fund. The fund gets reviewed essentially twice a year through the IRS, and you have a lot of testing requirements. And they put a lot of different restrictions on what we can invest in, how we have to invest. There's a thing called the substantial improvement law where we have to significantly improve the properties that we buy. We can't just buy something and paint and carpet and
just
call
cash
it a day.
flow.
It doesn't work like that. And so we have to be able to demonstrate that at a pretty detailed level. And so you can do it on your own.
But that's also good for the growth, because if you've got that, I'm not in the capital gains in 10 years it's going away. You want a project
you've got to
like that.
do something that's transformative. If you don't, if you buy a Walgreens and clip coupons for 10 years, you're not really going to get very much tax benefit. And so you have to buy something that's transformative. And you can, we have seen investors sell a business and try to create their own fund. And try to then go find projects and try to fit in within the rules. But it's about 10 to 20 times more complicated than your typical private real estate.
Yeah, because they got to beef up the business like you've done. I mean, you've got to really understand the tax. And there's a structure to this, right? The entities and how the relationships. What are the relationships that need to come together in order for this fund to happen? I mean,
well, you've got to have a fund manager that's qualified and can administer the fund. And if they mess that up, you probably won't find out until 5 years into your investment, and then you're paying penalties.
On an auditor.
And then maybe the fund's unwinding, and that becomes very complicated.
Yeah, not good for the track record either.
Not good at all.
Because the investor has penalties, not only
they flow through the investor. They skip over the fund manager and they hit the investor. So that's not good. Yeah. And then we're a developer, but we also co-develop and we partner with other developers. So they may have a project they've been working on for 3 years in an opportunity zone, and now they found out it's in this opportunity zone. But creating an opportunity zone fund, managing it, raising it, it's not quite going to fit their business model. Right. So we'll bring them in, we'll partner with them. So you need a really, really good deal network and a really good development community, because if the developer screws up their timeline, the investors pay the penalty. And so now you've got a mismatch of consequences. The developer has consequences that, obviously they could get fired, there could be a problem or whatever, but they're not paying those tax penalties, the investors are.
Right.
And so we've got to make sure that goes well, and we can step in and take over. And then the other constituencies are all the management companies, the service providers, the CPAs, the financial advisors, you name it. Everybody has a stake in this. And it's actually a very unique program because it's also connecting folks who are in the market rate private development business with people who are in the affordable business, in the workforce business, community development programs, local and state level economic development councils. It's incredible. It's brought us into a whole new level of relationships that we haven't seen before.
Yeah, I mean, you're uncovering this opportunity for your investors, but at the end of it, the deal is the deal. Like everything is still risk managed as an investment vehicle. This opportunity zone benefit is an upside.
Yeah,
but you're still looking at it. I mean, you're not padding the investment, or you're looking at it as, well, we can expect this, so therefore we can overpay for that, and we can go into the investment. So talk to me about the fundamentals. Is it the same fundamental real estate acquisition strategy?
It should be.
Aside from the development, I know development makes a little bit more of an incentive.
It should be. You if you're a developer, you should be doing basically running the same model you normally would. A lot of these tax programs, you sort of give up any return on the investment, and the tax credit creates the return. That's not how this program works. And so the main benefit is you have to grow the value of the equity over 10 years. And so if you're not investing in a good project that will do that, you're not creating any tax benefit, and the whole program doesn't really work. And so for us, we basically do the same type of underwriting for every commercial deal we do. We try to buy it, renovate it, or build it to an 8 to 12 cap on our cost basis, and sell it for a 4.5 to 8 cap in the market. I mean, and that creates a 2 to 3 times return on the equity. We cycle that, and we continue to grow the business. And so that underwriting model hasn't changed one bit. We're continuing to do that, and that's the way you have to do it in order to make the program work.
What do you think the obstacles are? I think in identifying. Well, or let me just back up. We'll talk about the obstacles that might be in place, but how do you evaluate a fund or a fund manager?
It's tough.
The strength of
it's tough decision. There's about 130 plus funds in the market right now. The vast majority.
But these funds can vary, right? They're like I know yours is very well diversified.
Right.
I mean, we saw the clip. We know the types of assets you're buying, and like you mentioned earlier, you don't have movements of people in and out. But
the majority of them are sort of the $25 to $100 million fund range. There's probably about 60 to 70% of them. A lot of them are focused on one single project or one single deal. So the investors have to take a step back and say, what am I comfortable with? Do I want to invest in one project for 10 years? It sounds attractive at first because you can get your arms around, okay, I know the person, I know the project plan, it makes sense to me. But what is going to happen to hotels 10 years from now with Airbnb? Do you know? I don't.
Right.
Did you know in 2009 that 2019 was going to look like this? Did you know in 2009 we were going to have President Trump and 3.2% GDP growth in the first quarter?
Right.
No. I mean, frankly, we don't know what 10 years looks like. And so doing a single project it's sort of the allure of it at first looks really good, and that's where most people are going because it's the simplest way to put one of these funds together.
Right.
But the first round of single projects that got built, or at least the land got purchased in New York in anticipation of Amazon's headquarters going into an opportunity zone. And when that didn't come through, those people lost.
That was a great story though at the time.
That was a great story. We almost bought one. Yeah. But that's so there's that, and then on the other side of the equation, there's these mega funds, $1 billion to $5+ billion funds run by some of the household names in finance, and these folks are obviously great at raising money because they have access to it. It's their clients, their investors, they're the Morgan Stanleys of the world and such, but they're not necessarily operators, deal people on the ground, et cetera. So those groups are then coming to look for groups like us and saying, hey, do you have deal flow? Can we partner? We can bring capital and such. And then we're one of the few in the middle. We're doing a $500 million fund. And there's sort of a 250 to 500 seems to be the range. And there's a few of us in the country that are actually not only raising the capital and properly managing the fund, but also active in the development space, have active deal flow. And most of those funds are regional in nature. So, I have my bias as to why we did the fund the way we did it. I think diversification is important. I think asset concentration risk is important. I think you have to look for a fund manager that has a track record working together because all of this requires significant execution over a 30-month development time frame. And even if you have a bunch of great people with great resumes, as we discussed, they may not have worked together. They might, they need to kind of bump their head against the wall a couple of times. So I think that's the best way to invest, but it really is the investor's preference. Do you want the big name brand and then basically end up paying double the cost because you're paying us and them? Do you want the small funds because you can get your arms around them, but then you're taking those concentration risks? Right.
I mean, you're putting a team together. It sounds like a professional sport. I mean, you have diversity in your leadership too, from tax to accounting to compliance, and you do these things for your own organization so you can better control your own investments, but also that creates some value.
Yeah, we have an executive leadership team, which is our CFO, who's 18 plus years with PwC in public accounting. Our president, who's my co-founder, and she's excellent at running the real estate and taking care of the assets and developing, et cetera. Our head of development, who runs development, construction, and acquisitions, and 35 plus years running this type of a business with his own money and his family's money. And then we have a 10-person senior leadership team that supports that with people like our head of construction, or our head of financial reporting, or head of tax. And then we have an operational leadership team that supports those people. So you've really got to build an infrastructure if you're going to invest this way over the long term.
Yeah, and that's great. And then, beyond that, the customer of tomorrow, the customer today, really, next generation leaders, the way that they view a place to, you mentioned Airbnb, the way that they access vehicles, all these things are changing home ownership, the idea of it, access being ownership now. Is important, but those customers also expect more from organizations. They it's no longer just about who's the most profitable company. And so with this opportunity zone stuff, I mean, is it exciting because you're actually going in and developing things that communities can thrive with, instead of just another investment vehicle or another Walgreens on a corner that's doing a great yield, but maybe it's that movie theater that they need, or stuff like that. So talk to me about the impact to communities.
People want to be inspired. They want to come to work every day, and they want to build stuff that matters. And that matters for us, us to attract great employees, because great employees, great team members bring opportunities, deals, better execution, better profit, all the things that you want as an owner in this business. And so we have an impact thesis in our Opportunity Zone Fund, where we're going to track the impact rate of return as well as the investment rate of return.
Oh, that's interesting.
Internal rate of return. And so, what is an impact rate of return? Well, we own a large portion of historic downtown Mesa, and as part of that, we're providing some support and some financial support and sponsorship, et cetera, for an annual music festival that's in its 5th year and still trying to grow. Well, that creates 20,000 artistic impressions a year. So we track that. Another project in our Opportunity Zone Fund, which for me, I was really excited because it's a great real estate deal. 20-year lease, 10 cap,
a lot of great
medical, all the great things about this particular deal. But then I started to learn a lot more about the medical side of this, because this particular deal is to bring in a behavioral health clinic that helps a specific subset of the population who has both a injury or some sort of comorbidity, as they call it, and a behavioral health issue. It's a major issue. There's people who can't go to a hospital and get treated the same way you and I would, because maybe they have bipolar disorder. They have something that says, hey, I can't take opioids and I can't be in the hospital for 3 days and get better. I need to be in the hospital for a month, and I also need to be treated for my psych issue as well as my injury, or whatever the case may be. And so because of the Opportunity Zone program and because of our fund, we're bringing a great profitable real estate deal into downtown Phoenix, but we're also bringing in a 98-bed program that's going to add the ability for the city of Phoenix to access this level of medical service, which is frankly a gap in our system right now.
Gives those families that work for you to talk about stuff, the things that they're working on.
It's a big deal.
Its impact.
Everybody has in their family some connection to some sort of person in their family, or either direct or indirect, that's had one of these types of issues and knows how hard it is to get those types of medical services.
Yeah. So where can people go to learn more about your organization and the things that you're working on?
Yeah, so I've got 2 places to point them. Our main website is caliberco.com,
Sure.
which is CALIBERCO.com. And that's where you're going to find out about us and our funds and all the details about what we're doing. If you're a non-accredited investor and you can't participate in the funds, one of the very unique opportunities that exist that will not exist for very long is our public offering. We're doing a public offering under Reg A+, which means that allows us to market the offering ahead of the offering and talk about it. It's called a Test the Waters campaign. So we're doing a Test the Waters campaign where people can go to caliberipo.com and sign up and say, look, I don't have a net worth of $1 million and 100,000 to invest, or $500,000 to invest, but I have a net worth of over 10,000, which is the requirement for Reg A, and I can put $5,000 into the stock, and I want to be a part of this growth story.
Right.
So caliberco.com for the funds, caliberipo.com for the Reg A+.
That's wonderful. Well, I appreciate you sharing the time with us today. And I'd love to bring you back and talk a little bit more. I know we're just in the early stages of Opportunity Zone and education. Yeah. And I know there's some opportunities to share more with our community as well.
Anything I can do to help, especially considering the fact that there's a timeline involved in the program where when they get a capital gain, they have to get invested within 180 days of that gain.
Right.
We regularly take calls where we've got someone, hey, I've got a $3 million capital gain, I've got 3 days left to make a decision, and I live in Alabama. It's like, okay, fly out to Arizona, let's talk, because there's a lot of decisions to make in a short period of time.
That's great. Well, Chris, thanks for having me on the show. Appreciate you coming out.
Thank you.
Stay tuned. We'll have more with Chris.
If you found this clip useful, please remember to like and subscribe for more. You can also visit us at multifamilystudios.com to view full episodes of our latest and greatest shows and interviews.